Jake is holding a gold bar. It weighs 400 troy ounces at current gold prices of approximately $3,000 per troy ounce. The bar in his hands is worth $1,200,000. And Jake is thinking what almost everyone thinks when they imagine owning a gold mine: that if you find the gold, the money follows automatically. Today, I'm going to show Jake exactly how wrong that assumption is, because the economics of owning a gold mine are simultaneously the most spectacular wealth creation opportunity in the history of industrial commerce, and the most expensive, most complicated, and most punishing business model that exists in the global economy: the exploration gamble. Everything in gold mining starts with a number that most people have never heard: 1 in 1,000. 1 in 1,000 mineral prospects that mining companies identify and begin exploring eventually becomes an operating gold mine, which means that for every gold mine that exists on Earth, 999 exploration projects spent money, drilled holes, analyzed rock samples, and found either nothing or not enough to justify the cost of building a mine. The exploration phase alone, before a single piece of mining equipment is purchased, before a single employee is hired permanently, before a single ounce of gold is produced, costs between $50 million and $200 million. And at the end of those years of exploration, the company learns whether the gold that was there is enough, at a grade that is high enough, in a location that is accessible enough, in a jurisdiction that is stable enough, to justify the next phase, which costs dramatically more: the permitting nightmare. Here's the detail that stops most aspiring gold mine owners completely cold. In the United States, getting the permits required to build and operate a gold mine takes between 7 and 10 years. 7 to 10 years of regulatory review, environmental impact assessment, public comment periods, tribal consultation requirements, water rights negotiation, and the constant possibility that any single regulatory agency at any level of government can issue a challenge that adds another 2 to 3 years to the process. And during those 7 to 10 years, the company is spending between $10 and $50 million on permitting costs alone, while producing zero gold, and while the price of gold, which was the entire basis for the economic justification of the mine, moves in directions the company cannot control. The construction bet: if the exploration finds enough gold and the permits are eventually granted, the company faces the largest capital expenditure in the mining industry. Building the mine, a major open pit. Gold mine costs between $500 million and $5 billion to construct, depending on location, terrain, infrastructure requirements, and the complexity of the ore body. And that construction takes 3 to 5 additional years, which means from the moment a company identifies a potential gold deposit to the moment the first gold is produced, typically takes between 10 and 15 years, and costs between $1 and $7 billion. And the gold price at the end of that journey might be completely different from the gold price at the beginning, the all-in sustaining cost reality. Here is where gold mine economics reveal their complexity to even sophisticated investors. The cost of producing gold is not simply the cost of digging it up. It includes every cost required to sustain the mining operation over its life: equipment replacement, tailings management, water treatment, environmental monitoring, community relations programs, administrative costs, exploration to find the next ore body before the current one runs out. When all of these costs are added together, what the mining industry calls the all-in sustaining cost per ounce, the average major gold mine in 2026 produces gold at a cost of between $1,200 and $1,400 per ounce, at a gold price of $3,000. That sounds like an $1,800 margin per ounce. And on 400,000 ounces of annual production, that is $720 million in annual margin. And the actual profit after royalties and taxes and debt service and reclamation costs is significantly less, but still substantial for a mine operating in a stable jurisdiction at a high gold price: the royalty and tax extraction. Before the mining company keeps $1 of that margin, multiple parties extract their share. The landowner, who may own the surface rights but not the mineral rights, receives a royalty typically between 2 and 5% of gross revenue. The government of whatever country the mine is located in receives a royalty typically between 3 and 10% of gross revenue, plus corporate income tax on the profits, plus potentially a windfall profits tax if the gold price rises above a certain threshold, plus export duties in some countries, and reclamation bonds that require the company to set aside hundreds of millions of dollars in escrow to fund the eventual cleanup of the mine site, which will be required decades after the last gold is produced. The geopolitical risk premium. Here is the dimension of gold mine economics that creates the most dramatic value destruction. and the most dramatic value creation simultaneously. A gold mine in Nevada, regulated by the Bureau of Land Management, operating under American law, with American courts to enforce contracts, is a fundamentally different risk profile from a gold mine in West Africa, or Central Asia, or South America, and also in India, where the government can change the royalty rate, can nationalize the mine entirely, can revoke the operating license, can demand equity stakes as a condition of continued operation, all of which have happened to mining companies operating in unstable jurisdictions. The company that built a $5 billion mine in a country that subsequently nationalized it lost $5 billion. The company that built a similar mine in Nevada has been producing gold and paying royalties for 40 years. The grade problem. Here is a technical detail that determines whether a gold mine is extraordinarily profitable or economically marginal, and it is measured in grams per ton. A high-grade gold mine produces between 5 and 30 grams of gold per ton of rock processed. A low-grade open pit mine produces between half a gram and 2 grams per ton to produce 400,000 ounces of gold per year from a 1 gram per ton deposit. The mine must process approximately 12 million tons of rock annually. 12 million tons, moved by truck, crushed, processed chemically, to extract what amounts to approximately 12 metric tons of gold. And the cost of moving and processing 12 million tons of rock per year is approximately $400 to $600 million annually, before any royalties, before any taxes, before any debt service on the billions borrowed to build the facility. Here's what the complete economics of a major gold mine look like in 2026. Gold price, $3,000 per ounce, production 400,000 ounces per year, gross revenue $1.2 billion, all-in sustaining cost at $1,400 per ounce, $560 million, royalties and taxes at approximately 20% of gross revenue, $240 million, debt service on construction financing, $100 million per year, reclamation fund contribution, $30 million per year, net profit approximately $270 million, on a mine that cost $3 billion to build, 11 years to permit and construct, and will produce gold for approximately 20 more years before the deposit is exhausted. You have been decoded. If this video made you think about the gold in your investment portfolio, or the gold in your jewelry, or the gold in the electronics in your pocket, completely differently, subscribe to Money Decoder 3004. Every single week, we decode the economics of the industries and systems that create and move the wealth of the world. Simply, honestly, and clearly. Drop a comment below. Does knowing the economics of gold mining change how you think about gold as an investment? Tell me below. I read every single comment, and I will see you in the next decode.